We are at a stage where the S&P 500 of US, which is a barometer of the US markets, is on the more expensive side.
I don't think RBI is wantedly trying to keep the interest rates low. There is a genuine case for interest rates being low in the country.
Composition clearly shows that about 60% of them are significantly valued much above their long-term average. And about 33% of them are in the PE ratio of 50 to 100.
The external sector is likely to have a huge impact on the Indian economy.
Environment, therefore, is a bit worrisome. So I think investors need to really look at the asset allocation and definitely keep powder dry at this point in time.
Ram, we are entering the fourth quarter of the year, and there's a lot happening both in India as well as in the US. So maybe time to take a look at the US economy, the Indian economy, the US markets, and Indian markets. A lot of stuff to cover.
Absolutely, absolutely. I think we are at a very curious place where the Nifty 50 hasn't moved much in about a year. It has been in a band of 24,500 to 25,500. And however, there is a sense that you are not finding too many bargains. Okay. Market is very nervous right now, given what's happening in the global scenario. And despite a lot of good investor friendly, consumer friendly stuff happening in India, such as income tax reforms, GST cuts, etc., a low inflation regime, markets have not really taken off. So it's a very interesting time. At the same time, gold and silver are just shooting through the roof, which again reflects the global uncertainty. And so investors need to really think through, is it, where are the markets headed now?
To understand the markets, let us first look at the bigger picture of the economy. Okay, the US markets, the US economy, as we approach the last quarter of the year, the forecast doesn't seem to be very good. GDP is likely to slow down, inflation is expected to shoot up, unemployment is rising, and there's a lot of uncertainty because of tariffs, immigration policy, and a lot of flip flop on many things by the US president.
Absolutely. I think, as the saying goes, if the US catches a cold, the world gets to sneeze. Or it's the other way. US sneezes, the world gets. But anyway, the point here is that we are at a stage where the S&P 500 of US, which is a barometer of the US markets, is on the more expensive side compared to its long-term historical average. It's around 25 to 28, whereas the long-term average is closer to 9, closer to 20. So that, but more importantly, it's highly polarized to a few, those top 7, 8 tech companies. And more importantly, the cyclically adjusted PE ratio, or the CAPE ratio, is has recently touched 40. And normally, whenever it has been that high, I mean, above 35 is definitely alarming. The 2008 global financial crisis also, S&P, the CAPE ratio did shoot up. So that is a sign of worry, as is the fact that bond rates have shot up in the US.
Despite cut in rates by the Fed,
Yes.
it's not reflected in the bond rates.
Absolutely. So I think that this environment, therefore, is a bit worrisome. So I think investors need to really look at the asset allocation and definitely keep powder dry at this point in time. Okay. And definitely secure their near-term goals with adequate money that is readily available. So, but then, the markets could all surprise us. They could, just gallop. But at this point in time, I'm actually nervous about what's going to happen in the US economy and the markets.
But what does it foretell for India? What's the implication?
Well, if you look at the Nifty 500 index, which is a good broad-based index of India, which covers all large cap, mid cap, and around 250 small cap companies, the composition clearly shows that about 60% of them are significantly valued much above their long-term average. And about 33% of them are in the PE ratio of 50 to 100. Now, we are a growing economy. Obviously, some companies can justify high valuations, but it is a good time for investors to ponder and see why uh, uh, a particular company is richly valued. Does it deserve that rich valuation? And if not, they should figure out a way to reallocate to more conservative allocations, I would say, at this point in time. Some leading fund houses are actually have increased their cash allocation. Um, so I think, and we are also doing that in our portfolio, carefully looking at valuations, looking at the expected results, which are when the result season is just kicking off, to see whether the companies have sufficient revenue visibility and the order books and the margin expansion and all of that. Obviously, IT sector has been has cast a fairly long shadow on the general mood in the market. IT has pulled down indices, and now with the next blockbuster results coming in the next few days, we have to wait and watch as to how the events unfold. So I think investors at this point, like always, I mean, every periodically one should look at the portfolio. I think this is a good time because of mainly the worry is about global events and global turmoil and what is likely to happen in the US. I think we as a country have a fairly strong trajectory ahead of us, but the short term, the next 6 to 12 months could be fairly turbulent. And the world itself will be a turbulent place over the next 10 years, but turbulence will be the new normal. Next 1 year will be a period of where some of these events could happen before the next big rally really takes off.
Yeah. So, in my view, the external sector is going to significantly influence India's GDP growth numbers. So, we've heard of impact on tariffs and all that stuff. I think that will start reflecting in the numbers in the coming quarters because we've seen exports taking a likely hit. Uh, our imports continue to rise because we continue to buy oil, we continue to buy gold, and gold prices are surging. So the external sector is likely to have a huge impact on the Indian economy, and possibly because of that, corporate profitability might get impacted, which can lead, which is probably giving us a sense that the valuations are rich. So while the broad picture looks like that, I'm sure there are many companies which will probably not get impacted because of this. So key once again is to look at company specific data, company specific circumstances, and choose the players who are likely to do well in future.
Yes, indeed, Manoj. I think while our GDP forecast is still holding steady, around 6.5 to 7% much more than what many other countries have. Still, the shadow is there, and the foreign institutional investors also, while we definitely like to say that look, they are not that influential in the long term, but in the short term, definitely those movements do have an impact. And this year we've seen a record outflow, and that has also been a dampener. I mean, in spite of the good stuff happening, and like I said, the US market events could impact these flows, and there could be a significant inflow back once, let's say, if the US market cracks and they find that India is a better place to invest. But definitely India's equity premium with respect to other countries has narrowed down, and India should be more attractive. And so after maybe a US correction, there could be a and India will also see some impact, at least for short term, if such an event happens. And then the FIs will probably rush back, and which will probably lead to the next rally. And which is why, again, on the long term, it looked like, look, FIs took out money in 2025, but still the market eventually went up, just like how it happened over the last 8 to 10 years, where they took money out 7 to 8 out of 10 times. So much for the FI flow thing. And I think the RBI also is in its monetary policy outlook, which happened earlier this week. They are suggesting uh, a soft interest rate regime. Why do you think they're doing that, Manoj? Is the intent to stimulate more capacity expansion by private companies and stimulate production?
uh, Unlike the US, where there is pressure on the Fed to reduce interest rates, India definitely has a case for lower interest rates. Okay, we have been experiencing record low inflation. Okay, and typically interest rates are a factor of inflation. On top of it, if the US is cutting interest rates, then no reason for India to increase interest rates. Uh, and therefore, I don't think RBI is wantedly trying to keep the interest rates low. There is a genuine case for interest rates being low in the country. Okay, but RBI is being cautious. It is not wanting to rush. It is taking a look at what can you know possibly go wrong, and therefore instead of saying accommodative stance, it is having a neutral stance. uh, this does bode well for both the Indian consumer as well as the producer. The consumer gets to borrow at much lower rates, and the producer has an incentive to increase, uh, capital into the business by again taking loans at much lower rates. So that low interest rate regime is definitely favorable and is likely to offset some of the impact that is happening because of the external sector, which we discussed about tariffs, etc. So, thankfully, we are in a state where we don't have to contend with higher interest rates or higher inflation.
Speaking of sectors, we've seen IT getting pounded, and actually, IT, for all you know, may be a contrarian bet for the next 2 3 years. Then financials are definitely likely to do well. The recent RBI guidelines and revised regulations for lending clearly want to stimulate credit. I mean, we as a country are just around 30% of credit penetration, whereas US is around 70%. So that's a long way to go for us, and that will definitely stimulate a lot of um, private sector activity. Uh, I mean, the other sectors being solar and renewable energies, um, consumer consumption, auto ancillaries. These tend to be favorite sectors as of now. Um, IT also, we'll have to see how the whole thing plays out. Of course, we have some results coming in, but I would say that large IT service plays best avoided for now. But niche IT, which are leveraging new technologies, definitely will come and do well.
On that note, as always, happy investing. Happy investing.